Welcome everybody to our first video on UK income tax. This topic is one that is really important for any business students to understand, and for anybody generally really, because you'll all be paying this whether you like it or not. There's only two things certain in life, death and taxes are probably the one thing that's universal for most people, unless you're a very rich sort of person who can easily set their tax affairs up in another country, which unfortunately a lot of us can't do. So let us begin with a little look at income tax. So the key things that I would say about income tax to start with are that it's money paid on earnings. So that could be shares, that could be earnings from the interest, that could be pensions, but most importantly, and most likely for most of you, that would be money earned on what you get for work. Okay, so whether you work in factory job, whether you work as a business person, whether you work as a plumber, electrician, a carpenter, whatever trade that you want to work in or do currently work in, it's money paid on the earnings from that trade, okay, or that industry that you're in. So that's the key thing about income tax. It's progressive in the sense that the more you earn, the more you pay, okay? So it's progressive in that sense. So, and the higher proportion of your income you pay as you go up the scale, which I'll show you about in a moment. It's banded. That means that as you reach a certain threshold of income, you start paying more of your salary or income in income tax. And there are two ways to pay income tax. One, probably the most common one, is PAYE, pay as you earn. And that's for most people that are in employment. In the conventional employment where you get a wage slip, most people will pay via PAYE. Alternatively, if you're self-employed or you do a lot of bespoke work, then self-assessment is the other option. Not very good at drawing straight lines using these tools, but you get the idea. Okay, so we've covered all those things. They're the key features of the income tax. So a little bit of context then about income tax. It was brought in 1799 by this fine, outstanding gentleman, William Pitt the Younger. Okay, the reason why it was brought in was to fight the Napoleonic Wars. So it was meant to be brought in just for the purposes of fighting that war. So which means it was meant to be, ironically, a temporary tax. So it wasn't meant to be around for very long, just as long as the wars went on and the cost of maybe the recovery afterwards. Ironic that because it's now probably the most famous tax of all in the UK, and it's the one we're most familiar with, because it's the one that most of us relate to if you're in employment. So we've certainly heard before that a tax is temporary. So when you hear government saying that tax increases are temporary or taxes are temporary, just remember that income tax in 1799 was originally meant to be a temporary tax. The key thing about this is it raises the largest share of UK government revenue today. So that entire pie of government spending, the largest share of that pie, or the biggest slice, if you think of it like that, comes from income tax. So you know that the money that government gets in through taxes, the largest share of that is through income tax, which probably isn't surprising considering there's so many people that pay it. So the tax base is quite big for income tax. Okay. How much does it raise? So you can see that on the left there, the chart shows as a percentage of GDP. So as a percentage of the UK economy overall, how much are these different taxes raising? You can see at the top there now, income tax, it sort of bobs around 10% of GDP. So quite an important tax there. You've got national insurance, which raises sort of 6-7%. You've got VAT, which raises between 4 and 6%. And corporation tax, which is tax that's paid by businesses on their profits, which sits around 2 or 3% generally. And you can see there at the bottom there, there's time. So from 1999 to 2019-20. Treat those years with caution because this was pre-pandemic. So I'm sure post-pandemic, you'll see that income tax possibly fall off, but equally you'll see GDP will have fallen as well. So it may stay around the same. But anyway, that's by and by. Income tax is the biggest earner for the government in terms of the taxes. So how does it work then? So everybody who works in the UK is entitled to earn £12,570 and pay 0% income tax. So if you earn £10,000, like Hayley does here, she's a cleaner, she earns £10,000, she won't pay anything. Okay? Once you start earning over £12,571, between that and £50,270, on anything you earn in that bracket, you'll pay 20%. Okay? So anything up to £50,270, you'll pay 20% on. Anything between £50,271 and £150,000, you will pay 40% on. And then, for those who are earning over £150,000, you'll pay 45% on everything that you earn above £150,000. So, Roy works as a store manager and earns £40,000 a year. He's entitled to that without paying any income tax whatsoever. And then the other, whatever that is, roughly £25,000, you'll pay 20% on. Okay? Ken is a CEO of a company and earns £140,000 a year. He's entitled to that as usual, the same. He's entitled to that, £12,570. Up until £50,270, he pays 20%. And then the rest of his income, whatever that is, probably roughly £90,000, he'll pay 40% on. And it doesn't work in the sense that, you start at the beginning of the year and you don't pay anything until you start earning over those amounts. It's spread out across the year, okay, on PAYE. So it's a consistent amount of money every month that comes out your bank account or out your wage slip. So just to sort of reassure that then, Hayley works as a cleaner 2 days a week and earns £10,000. She pays nothing. She doesn't pay anything towards income tax, okay? The government in the last few years has massively increased this personal allowance from 12,500 to 12,570 from about 7,000 in 2010. Roy works as a store manager and earns 40,000. He pays 5,500. So what you do is the amount that's between 12,571 and 40,000, about 27,500. He will pay about 20%. Well, he'll pay exactly 20% on. And then Ken, he pays a massive £43,431, okay? And 80p, in fact, because he will pay a little bit in the basic rate and then quite a lot of what he earns over £50,271 in the higher rate. Nobody yet is in the additional rate for these guys, but Ken is probably the closest to it. Right, so how did we work that out for Ken then? So a lower rate is paid on anything between £12,571 and £50,270. So in that case, the amount that you pay 20% on for Ken will be the £37,699 between those two bands, okay? And you pay 20% on that, so that's £7,539.80, that number there. So everything that he earns between 12,571 and 50,270, he pays 20% on. And then when he crosses that threshold, between 140,000 and 50,270, he earns 89,730, and that he pays 40% on, which is where a large share of his income tax bill comes from. £35,892 he pays on that. So his total income tax bill will be those two numbers added together, and you'll see there he pays a very hefty £43,431.80. Okay, so everybody will work their way through the bands, but it comes to a point, effectively, where the more you earn, the more you pay. Okay, that's why it's a progressive tax. So now imagine a multinational CEO based in the UK. So Susan earns £4 million per year. She's still got that same low rate, and she's still got that tax-free amount up to 12,500. Then she's got the low rate. It will be exactly the same as Ken's because they both earn over the threshold for that. So that's £7,539.80. She also pays the higher rate between the 50,000 and the 150,000 are 40%, which is roughly 39,892. And then the additional rate above everything that she earns at £150,000, which is obviously quite a lot of her salary because she's paid $4 million a year, lucky bugger, that will be paid at 45%. So 45 pence in every pound that she earns over that £150,000 goes to the government into income tax. So her additional rate payment will be £1,732,500, and her total income tax is that figure, £1,779,930.80. Okay, so a hefty tax bill, but she's earning quite a lot of money. And you've got to bear in mind that that's not the large sum, the total of her tax bill, really. She'll be paying national insurance, she'll be paying, obviously, VAT on things she buys, she'll be paying all the other things, council tax, etc., etc. But that will all come out of that £4 million salary, so I don't think we'll be too worried about how much disposable income she's got. So just to summarise how progressive it is, Hayley, she's only on 10 grand a year, she pays 0% of that total income. Roy, he's on a very healthy £40,000 a year. He pays 13.75% of total income and income tax. Perfectly reasonable. Ken, he pays 31% of his very, very handsome £140,000 salary in income tax. And Sue, because she's on that incredible £4 million salary, pays 44.5% of total income because she gets into that additional band, and most of her wages or salary will be within that additional band because 4 million is much higher than 150,000. So guys, that's income tax. I hope you enjoyed this little micro lesson. I hope you actually got something from it. If you did, please like, please subscribe, and please remember to keep following Business Brews for more of these small classes. Classes that you can take in the time it takes you to drink a cup of tea. Thank you very much.